good morning, everybody. It is Saturday morning. This is Multifamily Unplugged, and welcome to the show. I hope you're having a great weekend and enjoying what maybe the end of summer here coming up, huh? Kids are back in school, and seems like things are kind of getting back to normal. I know that my guest this morning and I have been trying to get together all summer, and our schedules have collided, or not collided, but have been dislocated and haven't been able to get together. But we'll get to our guest in a minute. Hey, if you're new to the show, welcome this morning. Always ask that if you like what you hear, then like us and love us. If you're on Facebook, join our community at Multifamily Unplugged, our Facebook community. And if you're on YouTube, smash the subscribe button. My guest this morning is Matt Ferguson. Matt and I met a number of months ago at an event I spoke at up in Wisconsin. Matt's with Chicagoland 1031 Exchange. He's from Western Wisconsin. Let me bring him in real quick. Matt, good morning.
Morning, Mike. How are you doing today?
I'm good. Good to see you again, man.
Yeah, it is definitely. It's definitely been, as we already kind of discussed, it's been a busy summer. So I'm glad that our schedules aligned and we're able to make this happen.
Yeah. Are the trees changing colors yet by you?
Not yet. I'm a good bit north of from where you are. I'm in Western Wisconsin, but I mean, for all intents and purposes, I'm in, we'll call it St. Paul, Minnesota, and the leaves are still green, but there's that little bit of kind of hint of fall in the air, the smell, and a few leaves are just starting to get kind of brown on the edges. So it's coming. Fall is my favorite time of year, so I say bring it on. I love it.
Yeah, I love fall too. That is my favorite time of year. I just can't believe how fast summer went, though. I mean, it just blew by.
I have little kids now. I've got a 4-year-old and a 5-year-old, and time seems to just going fast forward now. It's insane how much just having the kiddos around makes time just seem to go by. My daughter just turned 4, and I feel like not long ago I was changing her diapers. So I don't know where it went, but those days are already over.
Well, I can tell you, my friend, is cherish those moments. That's for sure, because they're gone before you know it.
That's what everyone says, and I try to heed that advice as much as possible. They say deprioritize your career, don't work too hard while your kids are young because you never get it back. And that part's tough for me. I'm one of the type of people that just loves what I do and loves to work, so that's always where I'm always trying to pull myself away from. But I try to make sure I do that. And all the cliches about parenting are true. So you could give any classic parenting advice, and at this point, I'm confident enough to say that it's just they're pretty much all true.
Yeah. Yeah, for sure. Hey, so let's get going here. And I always like to start out with one question, Matt. And I always say I'm going to write a book on this. But I ask all my guests in one word, what best describes you personally and professionally?
Yeah, that's a tough one because I don't know if you can quantify a personality into one word, but I'll give it a shot. I'm going to go ahead and say I think curious would be a good word to describe me, how I feel at least. If I like something, I want to know everything about it, and it goes both ways, I guess. If I'm not interested in something, it's like pulling teeth, impossible to get myself to learn anything or to figure it out. But when I'm really interested in something, I want to know every detail of everything that goes into it, and I can spend a lot of time digging and trying to learn more. So I think that's probably a fair word. I think probably at my worst, it can maybe be curiosity can almost turn into cynicism because I see something and a lot of my research and curiosity comes from, it's like, well, these people probably aren't telling me the truth, or these people don't know what they're doing, so I better learn for myself. So curious on a good day, skeptical or cynical on a bad day.
Yeah. Hey, I can relate to some of that. That's for sure.
Yeah.
But I think part of that is because you and I are both in the people business, and I think we get some of that from people, right? People.
I think so. And in previous jobs, I don't travel for work so much right now. I've always worked in real estate, but I've had previous jobs where I've traveled the country, and I've seen not every major city, but sometimes it feels like I've been to every major city in the U.S. And I spent kind of my late 20s and early 30s doing that kind of a job, and got to meet a lot of different people, and it's just been fun. You get to know different regions. One thing I find is that people are really different, but at our core, I think people are pretty much the same. Want the same things, want to accomplish the same things, and just how they go about doing it is different. And I really get a kick out of the different subcultures within the United States and different accents and things. So I really like to dig into why people think a certain way. Or I've done a lot of business on the East Coast. So I'm basically from Minnesota, and we're known as Minnesota nice, right? And East Coast New Yorkers, people from Boston, people in the Midwest anyway, I have an opinion of them as if they're, hard, mean, not very friendly. And there's nice people and mean people everywhere, but if I had to pick, I would say East Coast people are actually a lot friendlier than Midwesterners. They're just really direct. And so they communicate differently. And that's how that's one of the things that really always fascinated me about traveling, is learning those things as a polite Midwesterner going to New York City for the first time, working with clients. You call someone up, someone you've done business with, they say, "Man, I got nothing for you," and hang up. It's like, okay, thank you. I mean, do you want me to call back? And they're just saying, yeah, I don't have time to talk right now. Whereas something like that would be offensive in Minnesota. But in Minnesota, you could do business with somebody and they just can't seem to bring themselves to tell you that they're not going to do business with you. And so you can really go down a rabbit hole of wasting everyone's time just for the sake of politeness. So that's one of the things that kind of interests me about, I don't know, the different regions and traveling a little bit.
Yeah, interesting. Hey, were you in the service?
It was, yeah. How could you tell?
Yeah, that's exactly how I could tell. Well, I just, thanks for your service. Appreciate it.
Yeah, absolutely. Yeah.
Why don't you talk a little bit about your background and your history and what you're doing now?
Yeah. Well, I when I was I went to high school, and I'm actually live in I live in the town I grew up in, a little town called River Falls. It's a little college town, and it's in Wisconsin, but it's right on the border of Minnesota. And half the time, if I'm traveling, I just introduce myself as being from St. Paul, just because it's easier than trying to describe this little rural town right next door. I mean, I used to commute to St. Paul. If I do some kind of nightlife or something, I'm driving to St. Paul or Minneapolis. And anyway, so I'm kind of a small town guy. Married my high school sweetheart. We've been together. We just went to our 20-year high school reunion, and we've been together since before that even. But yeah, I joined the military when I was 17. Did a couple of tours of duty in Iraq, and saved my money while that was happening. I was a private, didn't get paid very much, of course, but didn't have any expenses, didn't have a house, didn't have a car, didn't have a family. And so I came home and I had $28,000 in the bank. So I was rich. And what am I going to do with my money? And my brother had given me this book to read in high school called Rich Dad, Poor Dad. And I don't even remember all the details about it, but what I remember and took from it today is just basically the concept of actively trying to build wealth as a goal. Not to be obsessed about money, not that money's everything, but just the concept of, if you manage your finances well, make a good living, save your money, invest it wisely, over time, it's just not that hard to build wealth if you make it a priority. And so I'm like, I want to do something like that. And my dad was a hobby DIY person. So he was really into construction. He was a corporate executive by the time he was an adult, but all of his college jobs, kid jobs he grew up in a rural place in central Wisconsin, didn't have a lot of money. So if he wanted to have something nice, he had to make it. And so he got really into building and building construction. And so I learned that from him. And flipping houses was really popular back then. This was 2007.
Okay.
And I was watching on TV. I thought, well, hey, I could do that. I'm rich. I got the money. And my dad has taught me enough, just like I can fix anything, I think. And so I got into flipping houses, did a couple of them while I was going to college. And 2008 comes along and the real estate market just starts going down, right? And I'm going to school all day, getting up, putting on or going to school until 12 o'clock, go to the library, do my homework, go to the project house, put on an army uniform covered in paint, and work on the house till I was too tired and do it again the next day. And anyway, I worked on that house. Got out of that deal with my shirt on. I made like $1,000 on it, but I mean, we're talking 4 months of heavy labor, for a really small payout. But that really kind of taught me that real estate investing was really all about the numbers. And I was an undeclared business major at the time. And so I thought, geez, I'm going to major in finance. But before that, I was really into what color should we paint this wall, and should we get painted cabinets or wood cabinets and things like that. And it just really all comes down to the numbers. And it kind of taught me that. Also taught me to be a little bit more conservative in my approach, just watching the real estate market completely collapse for a couple of years. So anyway, that really got me interested in real estate. Started buying. The market got really inexpensive. Still didn't have a lot of money, but the market got so inexpensive that there were properties I could afford. And so I would buy properties, sometimes with partners, sometimes by myself, and I built a little rental portfolio. In the meantime, I was building my corporate career and started working for investment real estate sponsors. So folks who do a version of what you do. I worked for my first real estate company was in St. Paul, Minnesota, a company called AEI Capital. They were a net lease sponsor. And so they would buy net lease properties post-development, sometimes immediately post-development, or sometimes seasoned assets that had been operating for a while, and put them into various different structures. I was on the TIC team at the time, Tenant in Common, and learned about the 1031 exchange game there. Coming out of the recession, there was not a lot of activity. I remember my first year in that business, I think that my territory, which was half of the United States, sold $750,000 of net lease real estate. Sounds like a lot. Tiny. I mean, it's like barely enough to keep the lights on for a company like that. But coming out of the recession, it got more popular. And then I started working for various different real estate sponsors. Ultimately worked for a multifamily sponsor most recently, doing DSTs, Delaware Statutory Trusts, as a vehicle to conduct 1031 exchanges. And now I still buy and sell real estate on my own. Working on a few projects right now. And then my day job is I'm a financial advisor, and I help folks, specifically folks who own business or investment real estate who are looking to exit, and help them defer taxes when they sell their property.
Which you do by 1031.
Correct. Yep. Sometimes opportunity zones if that makes more sense, but 1031 is sort of the main avenue for that.
So Matt, I have a couple of things that I want to unpack in there, but before we do that, let's get the 1031 thing out of the way, because I think we have some other things to talk about as well. Could you explain to people, what a 1031 is, how they benefit from it, talk a little bit about the fundamentals about it, and
yeah. Well,
okay.
At the highest level, and I know you know this, but maybe folks who are listening who maybe aren't aware, basically, if you have property that's held for business or investment purposes, when you hold it for a number of years or any amount of time, hopefully that appreciates in value, right? When you go to sell that property, you're going to get a tax bill. And the tax bill, especially if you've owned it for a number of years, can actually be pretty severe and sometimes pretty surprising. So you're going to get a number of different taxes: federal capital gains tax, any kind of state income or capital gains tax, and then a big one that people don't really know about necessarily is depreciation recapture tax. So all that depreciation expense benefit you've gotten over the years comes back to bite you in the form of what can be a hefty tax bill. And so I've had folks who, everyone's tax situation is very unique, but I've had folks looking at a 45% tax bill when they go to sell their property. And sometimes they've done a cash out refi. And there's situations where you sell your property, maybe it's got a mortgage on it, where the gain is actually more than the equity that you're going to get when you sell it in cash, and you might not even have enough money to pay the tax bill.
Right.
So that can be a pretty powerful motivator to do something about it. And if your goal is, with what are you going to do with that money when you sell it? If you have a specific liquidity need, like you want to pay for your kids' college, buy a Porsche, pay for medical expenses, whatever it might be, then okay, maybe you sell your property, pay the taxes, and move on. But if the goal is, well, I'm going to sell this property and the money's investment money. It's for the future. I don't need the cash right now. That's where 1031 exchange can come into play. Basically, if you follow the process correctly, when you sell your property and you buy property that's equal to or greater than the property you sold, and you invest all of the cash that you get from the sale, you can defer up to 100% of the taxes that are due.
For how long?
Indefinitely.
Indefinitely. So let's say that I do that over the next 20 years, and my family, my heirs, my estate take real estate at 1031. What are they still eligible for the deferral?
Are you ready to skyrocket your investment portfolio and leave a legacy? Are you tired of inconsistent returns received in the stock market? Do you think it may be time to take a look at alternative investment options for your portfolio? Passive investing in multifamily real estate could be that option. With no tenants, trash, or toilets, providing a solid return on an annual basis that outperforms traditional investing, also receiving a monthly or quarterly return along the way. These lower risk and secure assets are a great hedge against inflation. If you want to learn more about these types of opportunities, you can email me directly to schedule a 15-minute consultation to see if you qualify. Just email me at mike@mikemorawski.com.
Absolutely. So that's the biggest benefit. So if, again, you don't necessarily need the liquidity, you might want income from your property, but a lot of folks are more in the estate planning side of things, where their goal might just be to defer indefinitely and maybe live off the income the property generates, but then ultimately leave the property to their heirs. If you conduct a 1031 exchange, buy new real estate, whatever that might be, and then you pass away, your heirs will actually inherit your property at a step up in tax basis, meaning that your basis might be, if you have a $500,000 property that you bought in 1981 for 40 grand, and now it's highly appreciated, you have a very low basis. Your basis might even be zero due to depreciation. If you sold it, you'd be looking at a $500,000 gain. But if you pass away while you hold that property, your heirs will get it at a step up in tax in a cost basis, and so now their cost basis is the value of that property the day they inherited it. So they inherit it today; it's worth $500,000. $500,000 is their basis now, and so they could turn around and sell that property tomorrow, theoretically, have no gain at all, and take the cash and walk away.
Interesting. Wow, that's really interesting. I hope people, if you missed that, go back and listen to what Matt just said, because that's big for wealth planning, for generational wealth planning. Hey, so let me ask you this, Matt. So what if I miss my opportunity to do a 1031? So we know that there's some timelines involved. I have to designate a property within 45 days, and I have to close on it within 180 days. What if I miss that window?
Right. The window is very strict and it's very specific. And so I'll answer your question, but I might as well use this as an opportunity to point out what the window is. So basically, you have 45 days from the day you sell your property. That's called the relinquished property, the property that you want to sell. You have 45 days to identify or ID one or more properties that you might consider buying to complete your 1031 exchange. Once that first 45-day window is done, so let's say you sell your property on September 1st. I'd have to look at a calendar, but we'll say October 15th is your 45-day window. I'd have to see exactly if that's a number of days in September and all that. But so you have until, say, October 15th. October 16th, you can't shop for properties anymore. So you can only buy a property that was identified in that first 45-day window. And you can't identify everything under the sun. There's a few different rules you can use. The simplest rule to understand is the 3-property rule, where you can identify 3 properties, and those are your 3 options. You can buy one or all 3 of them to complete your exchange. But bottom line is that those are your options. 45-day window ends. You have a total of 180 days from that sale date, so that September 1st sale date, to actually close on that sale of your property and buy one of the properties or all the properties that you identified in the first 45-day window. And so those are the two big restrictions. The hardest part is typically the 45-day window. We all know how hard it is to buy real estate. Finding a property at all is tough, let alone in a 45-day window. And then you need to conduct due diligence. And so if it's a more complicated property that needs extensive due diligence, you might identify a property in the 45-day window, get past it and realize, shoot, I can't buy this property. I don't want, it's the due diligence came back and there's an issue. Seller, the deal falls apart. You have a seller, a contract with the seller, and for whatever reason, there's a lot of different ways deals can fall apart. And now, okay, I can't buy the property I wanted to buy. What do I do? And the quick answer is you're not going to do a 1031 exchange. You can only buy the properties that I just described. So your 1031 exchange eligibility is completely done, and there's essentially no flexibility in that. What I do for folks who run into that sometimes in certain scenarios is that's where opportunity zone investing can come into play. Opportunity zones are very different than 1031 exchanges. 1031 exchanges, you can defer taxes indefinitely, and you can buy any real estate at all that is going to be held for business or investment purposes. For an opportunity zone, you actually have to invest in an opportunity zone fund. There's a lot of different ways these funds are structured, but it has to be a specific fund, and that fund has a specific goal of investing at least 90% of its assets into what's called a designated opportunity zone. That's a whole other conversation, but bottom line is almost every state in the union has designated opportunity zones, areas that have been set aside specifically to encourage growth, encourage investment. Yep. And so it's a very specific tax rule. And basically, you can invest in an opportunity zone fund. You can just invest the gain you get from your sale. And then you don't get to defer taxes indefinitely, but you do get to defer them until the year 2027, January 1st, 2027. And at that point, then your tax bill will be due. The funds are typically set up to provide liquidity at that time for a specific way, typically with a cash out refi.
Yep.
And so you pay your taxes then, and you use the money that the fund generates to do so. And then you leave the money in for 10 years. And then the fund operates, does what it's supposed to do. Typically, it's a development deal where they're developing like a hotel near an airport maybe, or student housing near a university. And then they operate. So then they create income. And then in 10 years, if you hold the fund for 10 years, the gain on that fund that you would have realized is completely tax-free. So you do still have to pay the original tax bill, but it allows you to defer that and allows you an opportunity to make some money, hopefully in the meantime, while you're deferring in order to create the money to pay the tax bill. And then any new gain, as long as you hold it for long enough, will be tax-free. So it's also a very powerful tool. 1031s, actually, believe it or not, are easier, I think, and probably more powerful, but everyone's situation is different. And so some people, opportunity zones work great. Some people, 1031 exchanges are the best way to go.
And what is the tax rate today? So I know there's two different, there's short-term and long-term capital gains. What are those rates today?
Boy, I'd have to look at a chart. I don't off the top of my head. But
okay.
I usually use as a placeholder. So the federal capital gains rate typically tweaks every year, but I usually use long-term capital gain. 1031 exchange money, if you're doing an exchange, it has to be long-term capital gain. So if it's your first exchange, theoretically, there's some tax experts that say if you held the property for less than a year, it might be eligible to conduct an exchange. A lot of people say probably not. It depends on what your intent was when you bought that property, if you intended to hold it for long term or not. So we'll just go with 1031 exchanges should be for long-term gain properties. And I believe the federal rate is up. Is it 20% now? The highest federal rate? It's at least 15.
Yeah,
and then,
I thought, that's why I was asking the question, because I thought it was 15 and 22. So I thought short term was like 15 and long term was 22.
The reason I'm not, the thing is when I actually dig into these with clients, everyone's is different. So that's where it starts to be, it almost, So the highest is 20%.
Case by case basis, huh?
Yeah. And
so why would I want to defer my taxes? Why wouldn't I just want to pay them today? Because I'm really gambling, saying the taxes aren't going to be higher in the future, right? And we know interest rates go up, taxes go up, everything goes up, cost of goods. So why would I not just want to pay as an investor, not just pay my taxes today?
Yeah, I mean that's a fair question, and some folks we work with, the answer is you should pay the taxes, right? It definitely always comes down to your specific scenario. Realistically, if you are intending to reinvest that money, so the main reason you're going to pay taxes is probably a liquidity need. It's like, hey, the folks that I talk with, and I talk with people every day about this, and I've seen every scenario. I mean, I've been focused on 1031 exchanges for my day job since for going on 15 years. And so I feel like almost every scenario. Oh, there's probably, I shouldn't say that because almost every day I get, or not every day, but you'll see something where it's like, wow, I've never seen that one before. But bottom line is, folks who are paying their taxes are usually the folks, they just need the money. And that's okay. I mean, they might be wealthy people, they might be extremely financially stable people. And it's time to pay the taxes, right? And that's the goal of the investment. You have other needs for this money, and we're going to move on, and we're going to take the hit, hopefully planned for it. So these are people who probably didn't take a cash out refi along the way. They have a lot of gain, but they're also going to get a lot of cash from the sale. So paying the taxes still nets them a nice reward at the end. Realistically, if it is investment money, I've run the scenario 1,000 different ways, and rarely, if you're really like, I'm just going to pay the taxes and buy something else, right? Like you said, tax rates typically go up, not down. Inflation gets higher. Well, real estate's a great investment. Real estate income keeps pace. The income from real estate, rent income, oftentimes can keep pace, if not beat inflation. So I mean, it's a great hedge in that regard. And then realistically, so 15% isn't going to be your tax bill, most likely. I just have to say it a million times, but everyone's tax situation is different. But so 15%, 20%, that's the federal capital gains rate. In Wisconsin, now you're going to get hit with a 5.5% tax rate, most likely. And then depreciation recapture tax is as high as 25%. Wow. And so realistically, your tax bill is going to be pretty significant, and it's going to take a big bite out of your investable assets. And so even if you are going to buy, you can buy any real estate you want, provided it's held for business and investment purposes in an exchange, but you could buy something very conservative, and we'll say boring even, and it's probably, your odds are to do that, keep it conservative, keep pace with inflation, hopefully preserve your assets. It takes a pretty big return in, say, the equities market to start to make up for that 30, 35, 40% tax bill, if that's the situation you're in.
So talk about that comment you just made about the recapture tax, the 25% depreciation recapture tax. Talk about that for a minute.
So one of the great benefits of owning real estate are the tax benefits, and I'll throw 1031 as one of the tax benefits, of course. But while you're owning the real estate, you get hopefully income, right? It depends. Not all real estate creates income, but hopefully you own. I know you're a big multifamily guy. The power of the income it can generate. And what's really cool is you get to defer taxes on a lot of that income. So if you make $100, there's that's after your expenses. It's actually your taxable income is actually going to be lower because you paid however much you paid for the building, and you get to depreciate that. And so now instead of paying taxes on $100, maybe you're paying taxes on $50, right? And so $50 of your income is, and this is just an example, by the way, these aren't real numbers. I'm just throwing things out here for illustrative purposes. But that's not tax-free, though. It's tax-deferred. And so when you sell that property, let's say you've owned it for 10, 15 years, you've gotten a lot of income from it. And you've gotten a lot of depreciation expense benefit. And that's when you sell it, depending on your situation, depending on your state, depending on your income for the year. The depreciation or capture tax can be as high as 25% of all that realized depreciation that you've been taking over the years.
Wow.
And that's one that's kind of sneaky because it's pretty easy to calculate, even in your head. I'm selling a little property that I bought, I think, 8 or 9 years ago. And really quickly, I kind of calculated the gain. And I know what I paid for it. I know I did a light remodel on it just a couple of years ago, and I know about what that cost. And I have a general idea of how much income I've gotten out over the years. Pretty easy to calculate my estimated gains. Like, okay, I'm into it for X. This is my basis. But to get the depreciation or capture, I have to talk to my accountant because it's just like, boy, I don't even know how much I'm depreciated. So that one can be a sneaky one.
Interesting. Hey, I wanted to circle back for a minute, talk about early on in your when you were talking about you talked about net lease sponsor.
Yeah.
Dive into that a little bit for a minute and talk about that.
Yeah, so I use net lease today in some situations. The concept of net lease is quite different than multifamily, and quite different than I think the average person's idea of investment real estate. I got started buying single family houses. The idea is you buy the house, you pay for any improvements, you maintain it, you pay the taxes, the insurance, and also all the maintenance, and then the tenant leases it from you, and all the expenses are really associated, other than the utility bill and stuff might be the tenant's responsibility. But if something breaks, you're fixing it. When it's time to improve it, you're improving it, and you're certainly paying the tax bill and the insurance bill. Net lease real estate is quite different than that, and it's very specific, and it's a very different kind of sub asset class on real estate. And basically, the concept of net lease is you buy a property, and you get the tenants to pay for all of the expenses or most of the expenses associated with owning that property. Big ones being property taxes, maintenance, and insurance. And so essentially, they agree to pay you rent. They agree to basically treat the property like they own it contractually. So they have to fix these things. They don't. It's not their option to fix, something if it breaks or roof if it breaks or something like that. They have to fix it contractually, in addition to paying you rent. And the type of investors who do net lease, there's a million different ways to do net lease. The kind of most common, easiest to explain is basically you buy a property and lease it to a major corporation for a very long time. And so what you get out of that is stability. So it's great that the tenant's paying all these expenses for you. What if they can't pay it, right? What if the money's not there? And I think, in the single family, even the multifamily world, it's pretty, that's a pretty real question to ask. Like, hey, what if the tenant, sometimes we're concerned with the tenant paying rent at all. The last thing we want to do is make them responsible for maintaining my property. They won't financially be able to. But the idea is you get a very large corporation, is what you want. There's a million ways to do it. But you get a corporation like Amazon, you buy Amazon Distribution Center, is a great example. Amazon leases it for 15 years maybe, and they pay rent. Rent has built in escalators. It goes up X% every X number of years. And then they pay property taxes, maintenance, and insurance on the building. It's sort of like the bond world of real estate in a lot of ways. You got to be really careful with that example. It's definitely not like a bond, but if you're comparing stocks to bonds, and one's they have different risk profiles, kind of like that, to where the tenant, you're underwriting the tenant more than the real estate, because whether or not you succeed in net lease real estate comes down to, will the tenant make their financial obligations? And that's where you protect yourself by getting an Amazon or Walgreens or Starbucks to be your tenant.
So your average investor in a net lease opportunity, whether it be a Walgreens or a Kentucky Fried Chicken or an AutoZone or whatever, are they just getting a coupon, a monthly or a annual return, or are they getting equity in that deal also? And the reason I ask is I do multifamily, right?
Yeah.
So my whole philosophy is, how do we create cash flow, long-term wealth, and give some tax advantages, which we really kind of covered here. But on a net lease deal, are you getting all three of those buckets filled also.
You are, yeah. So basically, it's as simple as, I mean, there's many different ways to structure these types of leases, structure the types of deals, but at the end of the day, if you want to average it, or what you're looking for is a better way to put it, is you want to, you want to set it up to where tenants paying these expenses, but I own the property. And so I buy the property for whatever price I pay. And the average net lease investor probably buys it with a tenant in place or a lease in place at least. They might buy it from a developer who just signed a lease with Walgreens, right? And then Walgreens moves in and they contractually have to do X, Y, Z. And so you own the property, you're depreciating it, so you're getting your income in the form of rent that is sheltered by any depreciation you might be able to take. You won't write off things that you would write off in the maintenance category. So when you own multifamily property and you have to replace the flooring, that's a bummer because you come out of pocket for this expense, but it goes into your basis and it helps shelter some of your income, right? So good news in the net lease world is you're not having that expense. The tenant has it, but then the tenant writes it off on their spreadsheet, on their balance sheet, however they do it. So you're not having those expenses, but you still get the best way to describe it is think of it. Any benefit of owning real estate would exist in the net lease world, but you're not having, you're forcing the tenants to pay for more things than you normally would. Like utility bill is a good example. And the properties that I lease to tenants, I typically have the tenant responsible for the utility bill. That's their expense, right? So it says so in the lease. Sometimes you have to chase them for it, but at the end of the day, they pay the utilities. They put, that's their expense. It doesn't have a positive or negative impact on my.
Yeah, interesting. So, and I know based on your world, you really can't talk about specific returns or anything. Can we talk about generalities?
A bit, yeah.
Okay. So here's what I want. Here's my question. I could tell you on the multifamily private syndication deals that we do, that our investors will see upper teens return IRR returns on an annual basis. Plus, they get a cash flow along the way of single digits, and then there's the tax benefits. On a triple net deal, are you seeing on average more lower double digit IRRs, equity deals to mid teens, or are you kind of seeing the same type of returns that on a triple net that you would see on a multifamily syndication opportunity?
So, generally speaking, we do multifamily as well for clients, and I have to be very general just because.
Yes, I just want you to be general.
It's a good thing too, but the securities world that I work in, there's a lot of protections in place for clients, and so I have a lot of rules where I can't just go on a podcast and say, "Well, my clients made this much."
Well, we're not talking about a specific deal either, so we're really.
We're working with a client, and they want a higher risk, higher return profile. We're probably going to do a multifamily type program like yours. And we've seen returns all over the board, but the returns you mentioned might be a good example of returns some people get. The net lease world is typically lower risk, lower return. So realistically, we use net lease kind of sparingly. It has to fit a certain mold right now because you're kind of buying this long-term contract. So good news is Amazon or whoever, the tenant is agreeing to pay you for the next 15 years, maybe 20 years in some scenarios. And the lease is set. I'm going to get this much money every year. And then in the next number of years, it's going to go up, like a 5% every 5 years. Used to be a common lease term that would be built in. So it's like, I know what I'm going to get. And it can go south if Amazon can't make their financial obligations. But I mean, when you deal with big companies, that risk does get mitigated. And so, but lower risk equals lower return in most things, and that lease is very much in that regard. It's very much we use it for an income play for a lot of folks, where they're really focused on, look, this is the income I want to get, and income's paramount. And I don't like the idea where even though historically, lately, net lease incomes have done really well, they do have the potential to go down, right? I mean, that's just the risk of, and net lease income could go down. You could lose your tenant in certain scenarios, but it's just highly mitigated with, you're leasing to a big corporation. There's ways to mitigate it. And so we have clients who just really can't handle any kind of volatility, and that's the type of client you might suggest some net lease for. Back end when you sell a property, the thing about net lease is that the value is very much tied to the lease. So an Amazon lease with 15 years on it, that's a valuable lease, right? Well, guess what? If you want to sell that property in 10 years, now you have an Amazon lease that's only got 5 years left, right? Maybe they'll renew, maybe they won't, but at the end of the day, okay, that's worth less money. And so in a lot of ways, actually, there's a scenario where you can plan on a lower exit value than a higher exit value, which sounds kind of counterintuitive to a lot of real estate investors. Like, wait a second, you're planning on selling this for less than you bought it for? And there's scenarios where that exists, and which is why we use it sparingly. It's not for everybody, and neither is multifamily, neither is student housing, neither is hotels. Yeah, there are scenarios where I would say, as a high level rule, net lease is going to be more conservative, lower risk, lower return than multifamily.
Interesting. So let's talk about structure for a minute, and we've got a couple minutes left here. Talk about what a DST is and what a TIC is, or a tenants in common structure. And how does that come into play on the 1031 piece, whether you're doing a triple net or whether you're doing a multifamily deal?
Yeah. So the two different structures that lend themselves well to being securitized, neither one has to be a security. The tenant in common structure is common when it used to be the only real structure. When I got into this business, that was really the structure of choice from sponsors who were offering 1031 exchange eligible property. Those are right now the only two. There's some nuance to it, but high level, generally speaking, those are the two main 1031 friendly structures where you're going to buy into a program that isn't just a property that you found, right? So LLCs can do exchanges, as corporations, that all can do 1031 exchanges. If you want to, Mike, with one of your next securitized deal, maybe you want to be 1031 eligible, you'd have to have it structured at either a TIC or a DST. The TICs are more flexible. They have less rules than DSTs, so you can do more with the real estate, meaning you can do a deal where you can improve it. You can maybe raise more capital in the future, just generally speaking. DSTs are significantly less flexible. They're typically, you put the real estate in a Ziploc bag and you zip it shut and you maintain it and then you sell it. That's actually, believe it or not, that's actually the structure of choice these days because there's some nuance behind the scenes that it's simpler for investors. It's a lot less messy. But a TIC, you can get multiple people. Each person gets direct deeded ownership of the property. And it's the same type of TIC. And Mike, if you and me wanted to buy a property together and we didn't want to necessarily maybe do an LLC, just like I'm going to own it, you're going to own it, it's going to be a lake house. I own half, you own half. We're probably going to own that tenant in common. We each own undivided fractional ownership of our property. When we sell that property, for tax purposes, it looks like we each sold two separate properties almost. When I die, you don't get my property. My property goes to my heirs. So tenant common is the structure for typically small investor groups, or groups where everybody knows each other. If you want to hang out your shingle as a DST, as a 1031 sponsor, you're probably going to use the DST structure. DST owners own shares of the trust. The trust owns the real estate. IRS Revenue Ruling 2004-86 is kind of what blessed the DST as a potential option to be the 1031 exchange vehicle. When you pass on, your heirs still get the property, just similar to like a TIC scenario. So you always own the property. For accounting purposes and for all intents and purposes, it behaves as direct ownership of real estate. But because it's in this special trust, the trust owns the real estate, you own the trust. and then it has more rules associated with it, such as you can't significantly improve the property. So typically DST properties are going to be mature real estate, a newly developed apartment building that is already stabilized in rent. So basically the goal is the sponsor is going to buy the property with the DST structure. Investors are going to buy shares of the DST. The property is going to operate. The sponsor is going to operate it, distribute income to the investors, fix things that are broken, but not really significantly improve the property, and then ultimately sell it. And then the investor participated in the back end. If the property gained money and they sell it for more than they purchased it for, then the investors should see a nice return. If the property sells for less than the investors paid for it, then the investors would experience a loss.
So I have a couple questions around that now.
Yeah.
So let's just talk about. So I heard you say that it works best with maybe an A-class deal. But
Yeah.
what if I buy a C-class deal that's a value add that I'm going to increase the value and push what that property is, maybe from a C to a C plus type property in the market, because I'm going to go in and do some extensive renovations. Will that still work for a DST structure?
Depending on what you do to it. So you can take a C and turn it into a C plus without doing the big thing that you definitely can't do are major structural changes. So if you want to replace all the carpet, get new kitchen cupboards and all new appliances and paint everything, that's probably fine.
Okay.
If you want to take your 300 unit building and add another building, then maybe there's space to add another building, right? And you want to add another 150 units to it. Probably can't do that. So realistically, and that's a bit of a gray area, but realistically, structural changes are one red flag to, okay, you substantially improved it. But it is okay. And I have seen sponsors who have done, typically you get the plus. If you're taking a C and turning it into an A, my guess would be there's probably a lot going on there that, is probably going to be considered structural. But if the plan is to just do, lipstick type things, you're usually okay. But then the question comes into play, where are you going to get the money? Because DST's another rule they can't do is recapitalize. And so typically what people do in those scenarios, these type of deals are less popular. They do exist. But in this scenario that you described, that particular sponsor would probably have to build up a pretty large reserve account at the very beginning. And then the money's probably going to have to come out of that. DSTs aren't allowed to go out and look for any money to improve the property or to do anything like that.
Okay. So one more question. As a sponsor, when I bring an opportunity to the marketplace, so say I bring a 300 unit multifamily to the marketplace, and my raise on it is, say I need $10 million to go in and take down this property because I need the equity and the closing costs and some capital improvement costs. Can I say that half of that I'm going to do as a DST and raise $5 million in 1031 money, and the other half in just regular, passive investor money that are not doing 1031s? Or does the whole structure have to be a DST?
Probably the latter. There can be some funky things you can probably look into. My high level opinion on that, and I haven't worked for a sponsor. I used to be on the investment committee for a sponsor, and I would help work on a high level, help them structure deals. We had a corporate attorney and everything that did, the securities law attorney, all these things that kind of did the details, but I was more exposed to that. But it's been a few years. But realistically, in that scenario, I would doubt the DST would be a very good structure for that. If you're going to do half and half, I think a tenant in common structure would be more viable, to where you set it up to where half of it is owned as tenant common, or whatever percentage, half of it is owned as tenant common by, you typically use an LLC or an LP, or what type of structure would you normally use?
Yeah, we usually do a 70-30 split where we have the LPs on the 70% side and the GPs on the 30% side. So that 70% side, we could carve out a piece of that or half of that as a DST for create another asset class?
Realistically, what you'd probably do is whatever portion you wanted to be a TIC, you have the LP, both limited partners, because the LP is one structure that has general partners and limited partners, right? So
Right.
that LP is the structure that you're used to that would typically own the whole property. Perhaps that's one other path that owns now 50% of the property. The other 50%, and actually, I worked for a sponsor that actually did a version of this. The other 50% is owned as tenant in common by tenant in common investors, and then that portion can be you can securitize it if you do it the right way, and offer it for sale to investors as tenant in common, and then those investors can buy fractional ownership of the real estate, whatever minimum investment you want. Sponsors I work with typically do a minimum investment of $100,000. Sometimes it's as high as $500,000, depending on everything.
And then we can take our 50% and carve that up as a 70-30 and raise the capital on that other side.
I would say the 70-30 would probably still just exist in the 50% that's in the general part, isn't in the partnership. So
right.
The partnership does what it was always going to do, but it's 70-30 split. I don't know all the details of your deal. I'm kind of assuming a few things, so forgive me for
it's
that.
It's hypothetical anyhow. I don't have a deal. It's just hypothetical.
Yeah. But so you would typically create an LP and say, hey, we're going to buy this $100 million apartment building, and here's the structure. We have a split. We're going to do this. This is how you're going to benefit, etc. And now in this new scenario, that does exactly what it was always going to do. Only it buys $50 million of a $100 million apartment building. The other portion is offered as tenant in common through a different structure, and actually have seen that done, so it is possible. And we can talk about sort of the pros and cons from a sponsor side. So if there's folks who do sponsor deals, and that's the kind of thing they're interested in, there's definitely some pros and cons to that, and some pretty big hurdles you'd have to overcome, but that is doable.
Interesting. Well, Matt, this has been fascinating today. I know that when we started, I said to you before we actually went live was that we were going to go for about 30 minutes, and we have actually blown that out of the water. So I want to thank you for being here today. Your knowledge, and I knew that about you when we first met, that you were extremely knowledgeable, and that's why I wanted to get you on this platform to share that knowledge with my listeners, because there's a lot of new people, there's a lot of experienced people that listen in, and I want them to make sure that they understand, or at least get a different perspective, right? And maybe from what they're currently doing or what they have been educated on previously. So thank you very much. How do people get a hold of you if they want to talk to you a little bit more, or they're thinking about doing a 1031?
Call me old fashioned. I like phone calls. So that's actually, believe it or not, my favorite, phone call or text, and then set up a call or a meeting. So that's actually my favorite way, but you can email me. And I think I gave you my email. I have several email addresses if you want to talk about 1031 exchanges and the securitized world. You can email me at Matt F, MATTF, at chicagoland1031exchange.com. I'll let you figure out how to spell that. But it's long. But if you want to just talk real estate stuff and just, I do real estate deals on my own, small stuff, 1 to 4 family type units, little fix and flips here and there. Then you can just email me at Matt, MATT, at amfinsight.com.
Awesome. And that's scrolling at the bottom of the screen, and we'll have it in the show notes, and anybody who wants to reach out and connect with you. Hey, I want to thank you for being here today. I really appreciate your knowledge, your candor, and the things that we were able to talk about. So thank you very much. I'm confident that this was